Good morning. Welcome to YTD Insights. Today is November 14th, Friday before the market open. We've just had an absolutely terrible week of price action. The stock indices have fallen off its highs, but the real damage is in the high beta stocks and the cryptocurrency world. And now investors are really lacking the confidence to buy the dip in this market. So let's take a look at the status of the market as of today. First up, S&P 500 is still up 15% year to date, which is hard to believe given the broader sentiment that we're seeing, and is running ahead of the average seasonality of the past 10 years at this point in time. But the recent correction has put it back a bit closer to that average. Overall, I would actually still expect a new all-time high by the year end, and certainly at least holding the double-digit gains. Look at the monthly returns over the past 20 years. Novembers tend to be very bullish. We've had only one small blip in the past 15 years or so, since 2009, in which we've seen small negative return, but we're already down 1.5% this November after a 6-month consecutive run. So there is this one aspect where this run was very stretched from the April low, and now we are entering a consolidation corrective territory where it should have really happened back in October, but didn't. But going into the year end, typically there is a seasonal bullish sentiment between now and Christmas. And a lot of institutions actually have come back in to buy this dip, while retail and some hedge funds have sat out. And if you just look at the forward 10 days returns by the calendar day, between now and mid to late December, we're actually seeing very strong average returns in the past 20 years in this period. So while I do think the market is getting a bit more volatile, is taking a lot of people by surprise, the extended downfall, I do think we are towards the end of the correction rather than still in the middle of it. So one chart we have been watching very closely is the general account of the US Treasury. So you can think of TGA as the US Treasury's bank account at the Fed. So when it raises debt, issues treasuries, it brings money into the TGA. And when it starts spending money, for example, paying government workers' salaries, pensions, military spending, that money flows out into the real economy and the broader market. So it goes from the Fed reserves into the bank reserves. Due to the government shutdown, we are having an exceptionally high TGA level of $950 billion. And actually, as I checked, as just before the shutdown ended, it was $960 billion on Tuesday. But as the government reopens, this money will get spent into the real economy, moving into the bank reserves, and then investors, institutions have more money to bid up bonds and stocks and even riskier asset. So this is a matter of time when this comes down, and that will provide a liquidity flood into the year end. Just looking at our model signals using machine learning, SPY and QQQ are still very much risk on at position 1. So when the signal is 1, the model prefers buying or holding the position in the asset. And when it's 0, like the case for oil, it prefers selling or staying on the sidelines. So the model has also been quite bid TLT as well as gold, which has rallied recently. The model is bearish on oil, Bitcoin, Ether, and only today we are seeing the first risk-off signal for Tesla. So I think it's very useful to see the streak of the signals when the new signal establishes a trend. We're seeing consecutive ones that's still bullish and consecutive zeros. That means the model is quite confident that it's bearish. And then sometimes you have this new signal when the model prefers to sell at the market open, but it could buy back in the day after or on Monday if today's risk price action takes the model back to a risk on. So crypto has been risk off for a while now, actually, and that's why I've been warning lower potential for lower lows if you watch my past videos. But I do think from the chart analysis, we're getting quite close to the end phase of this sell-off. So SPY, what we're really looking for is whether we're going to have a lower low into this wave C. So at the beginning of the week, I wrote that this rally could be a wave B high that could retrace more than 80%, more than 78% of this wave A. And it now has started correcting downwards. We could have one more flash down to the 660 level where there is still reasonable volume, and that is the 100% extension of this wave A. Wave C can go all the way down to 650 as the 123% extension of this wave A. But my read is that we are probably closer to the end phase of this correction, so it's now happening quite quickly. We could take our new low today and start seeing buyers coming in at the end of the day, like it did last Friday, or potentially on Monday. So I actually think the bottoming phase would come quite quickly between today and Monday, and there's a reasonable chance that the market start looking for this wave 5 higher coming next week. Right now, there's a lot of uncertainty about the potential data that had been missing from the previous month due to government shutdown, and the Fed cannot have a clear picture on whether they should cut rates in December or not just yet. So I think when that data arrives, potentially the bad data is good data, weaker employment figures, and all could spur the market to pin in the December rate cut. For QQQ, we are seeing the 50-day moving average being breached pre-market, and there is heavy volume support around the 600 region. And if we measure the wave length of wave A, 100% of wave A will take us to 590-ish, and 123% will take us to 580. That could be the target zone for wave C. And I do expect this to come quite quickly if it happens. But now, I'm not extremely married to having a really steep pullback, as I suggested here in this wave count. This is just the standard expectation from Elliott wave theory. In reality, we could see buyers coming in between today and Monday at the lows to catch the dip, aiming for the year-end rally. And I do think with the government shutdown ending now, there's more liquidity into the system, and the Fed could be pushed towards a December rate cut. All of these tailwinds should give us new all-time high before the year end. And with institutions looking at those factors, they might try to front run that instead of waiting for this final dip into the 580, 590 region. So I think we just have to be quite agile and adaptive to what happens in the market in the next few days. Looking at the 30-year yield, it does appear fairly clear that we're now starting this wave 5 decline of the wave 4 high where we mapped around 475. Wave 5 could travel all the way down to 4.3 to 4.4. And I think that will complete the initial phase of this decline from the early top in spring. And I think this decline will likely be pushed by refreshed Fed cuts expectation. Then TLT is basically a mirror image of the 30-year yield. And I do think the next level will be moving higher towards the 90s with a target in the 93 region for this wave 5. US oil, we have been bearish for a while now. It really didn't quite get above the 200-day or the 50-day moving average here, and is now fallen below this resistance zone. So I think we are now likely moving towards this week 5 target in the low 60s, and our risk signal has been risk off for US oil as well. Looking at Bitcoin, I think we are getting quite close to my target region between 90 and 95K. So today it's trading actually right at this, within this mark of 95K. So if we get just a little push lower, I would say this sell-off is largely complete. That's actually also pretty much in line with what we saw from the previous sell-off cycle back in January to April, even though we've gone a little bit faster this time. And if we look at this ending zone, there begins to see some volume in the 92, 93 to 94 region. So I do think inside this green zone, it is actually still a buying opportunity, even though this chart looks very scary with potential death cross in the 50-day versus 200 and a bunch of volume here. I mean, there is an argument we can get a bounce and test a lower low as if we were back in March. That could also be true. So if we look at this pattern here, we are potentially saying we could have a bounce into the 100 region where there's heavy volume and then retest the 93K region. So that's also possible. But once we enter this region here, as you saw, this lower low wasn't actually much lower than the March low. I do think overall the risk reward begins to look quite good for the long side. Alternatively, you can always wait for our model signal to turn back risk on to give you that confidence. So our model signal actually turned risk on around 85K back in April. So not that much off the lows, but obviously you're slightly missing this 10-15% rally in exchange for better certainty. Ethereum, I do think we could probably touch this region in the 2,700, where there is significant volume around this price region. And we are looking at the target for wave 5 here at the 138% extension of wave 4. And it could go all the way down to 2,500 here. And I do think this sell-off could happen pretty fast. There's a very thin volume profile underneath 3,000. So we could travel directly down to 2,700 or even 2,500 in the next couple of days. But I do think from a technical analysis point of view, this region is attractive buying region. And of course, you can always wait for the signal to turn back on again. You will miss the initial rally because the machine learning model will need confirmation for the reversal of the trend. But in exchange for better risk management and certainty here. Solana, we are looking at 5 waves down in this wave C, and now it's very much within our target region now, actually. So 160% extension of this wave 4. It could, of course, go down to 123, but over here it does appear oversold and is a potential buying region. The problem with Solana, unlike Bitcoin and Ether, is not heavily targeted by institutions. It doesn't really have many ETF offerings, and it's not as liquid. So in terms of risk management, I would prefer buying Bitcoin, buying Ether at attractive prices. Solana, I'm a little bit more cautious from an institutional investor perspective. Coinbase, is actually coming into our target region now, around the 100 to 123% extension of this wave A from the wave B high. We begin to see some volume profile in this region that could potentially buy the dip here. And I do think if we get to this level here, it is quite an attractive opportunity. Coinbase has been risk off as well in our machine learning model. So one could decide whether to wait for the model to turn risk on. However, I would caution that it's better to have a strict stop in this market regime, because once we fall through the 240 region, we could easily gap down to below 200, and it could take a while to rebuild. And this bullish chart could be simply broken, and we have to regroup from there. Robinhood, what I am suspecting is that we could be in an ending diagonal where each of the 5 waves see 3 subwaves. So ABC over here on the first wave and ABC over here. So this wave C, again, at the 100 to 123% extension of this wave A, could reach 112 to 118. There is some volume profile here as support, but if falling below 110, the volume begins to get very thin, and I'll get very cautious. Potentially, we could have topped in this wave 5 already. MSTR, I highlighted last week that we likely see lower low here breaching this support region, and this is a corrective structure inside this wave 4. Now, this wave 3 is actually quite inside this wave C is actually quite steep, and in a sell-off like this, there's not much you can do except for just wait to see where it really lands and map out the next bounce before you can really determine where this wave 5 goes. But overall, I'm a little bit cautious on MSTR, because when Bitcoin rallied, MSTR failed to rally, and when Bitcoin sells off, it sells off harder because it's trading at a premium to its NAV. BMNR. So BMNR, this appears to be the first wave of the correction, wave A, and we have the wave B bounce. And I think we're now in the wave C, and that is in line with the Ethereum price action. And over here, 31 to 35 is the target region for this wave C, and that does line up with Ethereum trading around 2,700 to 3,000. So I think we're now in this ending stage of the pullback. It could consolidate and meet the 200-day moving average before the next rally. But here it does begin to look a bit more attractive in terms of the buying opportunity. SharpLink, SBET. I'm not really sure if you noticed that in the past couple of days, SBET has been a bit more resilient than BMNR. My read is that now we are in this ending target stage of wave C. Of course, it could fall back a little bit lower into the low 9s, and that could put us in line with Ether falling about another 10%, but NAV staying the same. But overall, if you're bullish on Ether, it is in the long run, I do think SBET is not a bad idea to buy in, given it trades about 20% below the NAV level. Looking at gold, we are seeing gold resurging recently. We could be beginning this wave 5 rally. And what I would say is that historically, gold doesn't top until the stock market topped. And the reason is that when we get a big crash in the stock market, gold acts as a safe haven. So it actually has that little extra boost for a few weeks after the initial crash in the stock market. And then after that, liquidity drain sets in because everything is selling off. Investors need to sell all of the assets to raise money, and then gold actually could go down as well rather than staying flat. I do think we should see one more high here. And the real sell-off for gold will begin when the stock market rolls over, potentially in 2026. Silver, SLV, the chart looks very similar to gold and actually probably has performed a bit better in terms of relative strength. I do think we're looking at potentially wave 5 here, and that could extend above $52 in the SLV. Apple has been a pretty amazing defensive stock in this market, just slightly off its highs, even as the rest of the market rolled over. So I think there is a sense where investors are using Apple as a defensive strategy in this sell-off without having to go all the way to cash. Overall, I do think Apple is in wave 3 as we approach Thanksgiving and the winter holiday season. I do think we should see it approaching the wave 3 high, at least in the 290 region. Amazon here has filled the gap, which is not what I wanted to see. And potentially we could be looking at an ending diagonal structure where wave 4 overlaps with wave 1. And in that instance, we could see a lower wave 5 than what I had originally anticipated. So if wave 4 is in a steeper pullback, we could be testing 230 or around the 50-day moving average to complete this wave 4 low. So we will project the wave 5 again once we establish the low for the wave 4. For Google, we are looking at a steeper drop down in wave 4. Now that wave 4 looks more like an expanded flat, and it could potentially trace down to 266, which is the 1.618 extension of this initial sell-off in early November. I do think there is enough momentum once the market recovers for Google to make one more high in this wave 5, but the risk reward isn't really that great over here. So Meta, I'm fairly confident now that we are in a 5-wave down trajectory, but I have left the potential for this wave A, B, C in place. The key is to see how the stock unfolds in the next bounce and whether it gets rejected by the 200-day moving average. So that will be our clue to confirm that we are actually in 5 waves down in this large degree wave 3. What that really means is that every rally then becomes the sell the rally regime opportunity, and I'll be quite cautious playing on the upside. Microsoft hasn't revealed much about its hand in this sell-off. This November low was pretty much on par with the September low. So it's still feasibly, this could be a 1-2, but I'm more cautious now that it's probably more a flat pattern where we see wave C trading close to 480 to 490 region before it finishes. So I think we just have to keep on watch. If once this low is breached, we know this is a wave C in completion, and we go from there. NVDA could have had the wave B high already. Now it's traveling in wave C. This region around 180 is pretty critical for the bullish side to uphold. There's the heaviest volume profile, but also if we breach this low, we are signaling we are down in wave C, which can go all the way down to 160 to 170. And in a worst case scenario, this could actually be a 5-wave structure, and we could actually go all the way down to low 160 to even high 150s before the next bounce into this volume region. So I'll be quite cautious about NVIDIA. Tesla is at a critical point right now. The reason it's at a critical point is that once it breached this wave A low, we are definitively in wave C now. And this price region is very, very important because this is now an expanded flat structure where wave C can trade all the way down to the 1.618 extension of this wave A, which is 380. And also over here, we have the volume weighted average price from the August low, which has more or less upheld since that date with an additional buffer of 4% below. So it's never traded more than 4% below the average price since August. We're really testing this threshold here. So 1.618 extension plus the 4% of the average volume weighted average price. If we fall below this, it could become the sell the rally regime. So be very careful in that scenario. PLTR, I do think there is a reasonable chance we have topped in all 5 waves, and now we're going to test at least 157, if not 155. So this region still has reasonable volume as support, but falling below it, we won't see any support until 138 and the 200-day moving average here. Finally, SOXX is testing the 50-day moving average, and I could see it moving all the way down to 268 at the 0.23 retrace of this wave 3. So that will be the minimum target for wave 4, where there's also reasonable volume profile here. So that's it for this week. There won't be a webinar next week because I'm actually traveling. Excitingly, I'm going to New York. Not so exciting when this market tanks like this. But after that, we have Thanksgiving anyway, and our next catch up is after Thanksgiving.